Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. There are the opening bells, and that means it is time for the cash market to get started, but that doesn't mean that the futures market has been asleep. It has already been on the move, and we're going to take a look at that. Speaking of not sleeping, it's my good friend Michael Fairborn out there in the chat. He is a great resource. He's a 20-plus year veteran of the financial markets, and he is there to help answer your questions along the way, whether you're here in the live version where you have the opportunity to ask those questions, or if you're in the recorded version, you can send us a message by leaving a comment in the comment section. We'll get back to you as quickly as we can on that. So I went out to take the trash out this morning early before I went on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. And noticed that there was a little bit of frost this morning on the windshield of the car. So it's getting a little colder, and that means that the heater's starting to kick on a little more frequently. That maybe means that natural gas is moving. We're going to take a look at that here right off the bat as we get into this, as well as a couple of other things that are moving. But first of all, remember that everything that we talk about is simply for illustrative and educational purposes only. It is not a recommendation or any particular advice. Remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. Make sure that you read the risk disclosure statement for futures and options. Remember that also when we talk about specific products, futures trading requires separate trading authorization. Also, remember that trading virtual currency derivatives involves unique and significant risks. So make sure that you read the relevant investor and customer advisories regarding those particular products. Remember that virtual currency derivatives, digital representation of values that function as a medium of exchange, they do not have legal tender status. Also, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. Not a guarantee of future success out there in the real world. It doesn't do certain things that the live trading platform will do. In this particular case, the one that becomes relevant to us today is the fact that it doesn't run studies in scans, which became a frustrating element for me this morning as I was looking at things. We'll talk a little bit about that. Of course, also remember that stop orders behave a little bit differently when it comes to trading futures. We'll talk about that as we get into this discussion. But just remember that due to exchange rules based on certain conditions at the time of activation, an exchange may substitute an exchange-designated limit order for an originally triggered market order. We'll jump in and take a look at what's going on here really quickly. I'm going to pop over to the Thinkorswim desktop software platform. The position that I was looking at here this morning in relationship to that frost on the windshield this morning was natural gas. And natural gas futures seem to be, at least over the near term, and looking at our typical chart here, chart setup with a 1-year daily chart and a today 5-minute chart on the right-hand side, seems to be on the move, not only in the short term, but also in the longer term. Short term, we seem to kind of have this trend moving a little bit higher here. Let me put my pointer on this, and you can kind of see that trend that's been moving higher, touching over this resistance area that I've drawn in here this morning, pulling back a little bit to the 10-period moving average, but the 50-period simple moving average still moving solidly up. The 10-period moving average still moving solidly up. Now, the CCI, that commodity channel index, that indicator in the lower panel, kind of backing off just a little bit, as is perhaps expected when it's running into perhaps a little bit of a resistance level. That resistance level overhead is over here. The one that I'm looking at on the right-hand side that is relevant to what's been going on is this one right here at about the 4.386 level. That was, or has been over the course of the last day or so, a relevant level of resistance. That's kind of the midpoint of this candle yesterday in this move. So we see the pullback down, the rally up, and the break through that level. So here's how this short-term trade might set itself up in terms of a short-term kind of bounce move, which seems to be a typical type of move that not only this particular instrument, but others tend to move in. And this is a similar type of bull flag type of pattern that we've looked at before. I'm going to go to the right-hand side, then we'll come back over here to the left-hand side and look at some of the circumstances specifically about this futures contract. So I'm going to click on the maximize sell button here. Lower panel is MACD, upper panel, these are 5-minute candles. So what I was watching this morning was this breakout, the little bit of a pullback, and then the bounce. So let's zoom in a little bit closer. I know that some of you have requested that we get a little bit closer with these candles, so I want to be accommodating of that so that you can see what is going on. I realize sometimes these faster candles tend to be a little bit mashed up here, so I wanted to kind of bring this into perspective. So we saw the breakout of the resistance level, a pullback and a retest, and now a bounce and a move higher. Now, does that guarantee that it's going to continue to go higher? Absolutely not. But as we start to set this trade up here, here's what I'm looking at. I'm just going to put in my points on this particular chart so that we can see what we might be looking at here in this particular trade. So our entry is going to be a market order, which is going to get worked as an exchange designated limit order, because the condition for entry into this trade has already been met. So that condition came on this breakout. So I'm still going to label that E for entry, because that was the trigger for that entry here into this particular type of trade. I have not entered it yet, so I wanted to use this discussion to put this on. The target in this particular case, now it could go further, but we're looking at doing this in a short-term time frame. The target is that previous high that we saw on the longer-term chart, on the one-year chart. That's up here at 4.52. So I'm going to put a T up here for my target. That's my take profit, theoretical profit target. And my stop, or my point at which we'd get out of the trade if it starts to go against us, or at least attempt to get out of the trade, because that's not a guarantee, is right down here, and that's at 4.35. So I'm going to put an S at that level. So stop, or entry, stop, target. That's how we're going to kind of line this trade out. I like that. SET, stop, entry, target. Yeah, SET. I like that. Or TES or ETS. I don't know. You can do it any different way that you want to. All right. So what we're going to do is I'm going to come back up here and I'm going to right click, and you can see that this is moving. And as I talk, it's losing potential here. So we're going to right click and I'm going to go to buy custom with OCO bracket. Now, the first thing that we're going to do is we're going to determine our target and our stop. We're going to put those in here. But the thing that we want to make sure of is that we know where we're going to get into the trade. So here's the thing. If I put this order in, now it would have been one thing if I'd put the trade on beforehand and I had put on a buy stop order. We've done that before. This is stop, wait, don't do anything until the stock or the futures contract triggers a particular price, then get us into the trade. We can still do the same thing. But it's already given us that condition that we want to get into the trade. So here's what I might do. I might use the top of that candle, since it's not fulfilled that candle yet, that 5-minute candle at 4.429, and I might make that my limit price. So it says buy at that price or better. So when I put a limit order in, remember, a limit order says buy at this price or better. A buy stop is going to trigger a market order, which is going to get worked as a limit order by the exchange. So we're going to say, all right, fine, as long as it's not gone beyond 4.429. Now, I'm going to set my target at 4.52. 4.52 is going to be my target overhead. 4.52. And I'm going to read through these because I've made a couple of mistakes in the last few weeks as we've been putting these trades on. So 4.52 is where I want to get out of the trade if it goes in my direction. And if it goes against me, 4.35 is where I want to exit the trade. 4.35 is where I want to exit the trade on a good till canceled stop market. Remember, stop market is going to trigger a marketable order as well, which is going to get worked as an exchange-driven order. And there is the potential that order might not get filled. Now, you notice what just happened here, 4.429, so we're right under our limit price. So I'm going to click on confirm and send. I'm going to read through this order, make sure that it is in order to open buying at 4.429 limit. So buy it at that price or better. And then sell it at 4.52 or sell it at 4.35 if it goes the other way. Now, sell will answer that question here in just a second. So we're going to take a look here now at this transaction cost. We make sure that we're aware of those transaction costs, our buying power effect, or in other words, our initial margin into this trade is 4.09. So I'm going to put this in my futures group, and we're going to go ahead and we're going to click on send. Now, this is going to sit there because you saw what happened, right? Now, once it clicked below that limit level, and it filled the order. And now there's no guarantee that this is going to go back up from here, but it had to get below that limit at 4.429 in order for that order to be sent, because that limit condition says buy it at this price or better, 4.429 or better. And it did. It had to wait for that to happen. Likewise, if we had put that in as a buy stop, that would have been a waiting condition that would have said, hey, don't buy this until it gets to that price or above. So kind of two ways to approach it from different sides of almost the same coin, if you will. So that's kind of the approach that we might take. All right. So in this particular case, and you're saying, okay, look, we're looking at this and we're saying, well, is this bearish or is this bullish? I'm still going off of, and I don't know yet, and I'm willing to take this trade given the strength of this momentum down here in the lower panel and the bounce up off of that support level. Ideally, I could have gotten into the trade theoretically on this breakout of that resistance level that I had drawn in there. I didn't, because that was earlier as we were getting up and started. But I wanted to walk through this with you. Now, our target for getting out of the trade is right up here, 4.52. So right about there. And our stop for getting out of the trade is down here at 4.35. That's how we've put this trade together to get out of this trade. The expectation is going to be that the price of this futures contract in the short term continues to move to the upside. Now let's move over to the left-hand side. And you can see, because I've got the same drawing set on both of these charts, if we zoom in to these longer-term candles, now each one of these candles represents one trading day. I'm really in this short-term trade. I'm really in this short-term, and again, this is a swing trade, moving from this kind of midpoint breakout to the previous high. Now, in a longer-term trade, and that's where this might transition itself into a longer-term trade, because if it breaks this resistance level on these one-year daily candles, we're really now, if we go back out and zoom further out to the whole one-year time frame, a breakout of that resistance at the 4.52, 4.53 level would perhaps be an entry signal into a longer-term trade. So you might say, well, wait a second, why did we just leave this as a target order, as an OCO bracket order, to get out at that particular target? Because this is oftentimes what happens, and it is the idea of blending or kind of mixing our targets. We as human beings tend to kind of bleed our priorities back and forth a little bit, especially when we're trading the difference between a short-term intraday type of trade to a longer-term trend type of trade. Now, I know Michael Fairborn has taught our trend trading class. He's also taught the Bounces and Breakouts webcast. And sometimes there is a tendency to just say, all right, I'm going to turn this short-term trade, what my expectation was a short-term trade, into a longer-term trend trade. And then what ends up happening is perhaps you're not thinking about risk management in the context of the longer-term trade. And now you leave a stop on that maybe is too tight and you get kicked out too early for what would otherwise be a trend trade. So my particular habit, and again, that's just an illustrative example, by no means any kind of recommendation, is to separate the expectations. If I'm going to trade a trend trade and I'm going to simply trade that trend until that trend ends, I'm going to enter on a trend-based signal. I'm going to exit on a trend-based stop, and I'm going to let that trend continue to materialize as long as it continues to move, and I'm going to adjust that stop up. But a short-term trade where I have a swing trade, where I have a specific target and I have a specific stop and a particular expectation for that trade, perhaps trading that as a separate entity can help to avoid some of those psychological characteristics that we tend to kind of bleed back and forth our priorities. Because if you don't know what type of trade it is, how are you going to know how to exit the trade, right? You've got mixed, you can't serve two masters here. You can't serve the trend trade master at the same time that you serve the swing trade master. Now, could we traded two contracts and said, fine, at this level, the target level, I take one of those contracts off, and on the other level, as it goes through that level, I just let that go? Absolutely. And as long as you kind of separate those from that standpoint, right? In terms of your trading psychology. So let's go back over to this chart really quick and take a look again. And what we might do is set up another order for a trigger as it breaks through that resistance. So we can do that here in just a second. But I wanted to go through the characteristics of this particular move. So when we start to see these numbers, this is a custom label, and it's here in my futures labels right here. It's the custom study that I've scripted with Michael Fairborn's help, by the way, learning ThinkScript. Mike Fairborn teaches the ThinkScript webcast on Thursday afternoons, and he does a phenomenal job with that, by the way, if you haven't been there. But what this is showing is the tick size, which means what's the significant digit that we need to pay attention to in terms of its incremental move. And the tick size is 3 places to the right of the decimal. So we go 3 places to the right of the decimal, and there it is right there. It's that number right there that just moved from 7 to 6. That's our tick size, and that's our tick increment as it moves that, right? The tick value, every tick that changes is $1. So when that goes from 3 to 4 or 4 to 3, that's $1 movement. And then when we talk about a point value, when this point goes from 4 to 5 or 5 to 4, that's $1,000 in terms of that movement. So you take $1,000 times that value, and you get your notional value of the contract. Now, this is the micro contract. And by the way, yeah, I will go ahead and share this. This contract, or this chart is also listed in the description for this particular webcast. And so I'm going to go ahead and I'm going to share that. This will also have that that label on there as well. So whenever we share anything, remember it is not guaranteed as to time or accuracy. It is not a recommendation. But if you're watching this in the recorded version and you can't see the chat, it's also going to be in the description of this webcast under that Futures Movers grid. You'll see it there. Speaking of clicking on things, by the way, I happen to notice that in the chat there is a feedback survey, and Michael Fairborn has reposted it here so that you can click on that, let us know what you think, and let us know how you feel about this particular webcast. 2 questions and then an open answer field, so we appreciate that. Ted asks a question: are all micro contracts a tenth of the regular size contract, or some another size, such as 100? And I think that there are some. I think that generally the designation micro refers to that 1/10, but that is, I don't think, always the case. There are some other specifics in terms of those contracts. So what we can do is we can come over here to the drop down, and we can look at futures, because you're going to have things like, if we come up here to the top, you're going to have things like the 1 ounce gold futures contract, which is a smaller size contract. It's not labeled as a micro. But I think the CME kind of naming convention topology here or taxonomy is that the micros are a tenth of the larger contract. And remember, we talked a couple of days ago or a couple of weeks ago about some of these new micros that are coming on, including this micro natural gas futures contract. But we see that there's that initial margin, 409 per contract. You can see the tick value and tick size listed here as well in all of those information pieces, right? So start to look at some of these other contracts. Now, there are minis. We take a look at something like the E-minis for, say, for instance, S&P 500. The S&P 500 is what's referred to as an E-mini contract, but there's also a micro ES futures contract. So you do have some choices in terms of the size. And you can see the difference in some of those notional values. Even the E-minis, if we click on that, you can see the notional value here is 342,962 or 67. And you pop down here and you see that the initial margin for a trade, say for instance, on that E-mini contract, in this particular case is $22,000. So that's a fairly large chunk of capital that needs to be held aside for that initial margin into that trade, which is why there are some of those micro contracts. So here's the micro ES. And you can see that at least from a margin standpoint, from the notional value standpoint, yeah, it's a tenth. The initial margin standpoint, it is a tenth of that notional value. So but you can see that it moves in the same fashion. So Carol asked a question. So isn't all gold traded in ounces? Yes, it is. But when we're talking about, so let's talk about, say, for instance, the gold contract. So let's come over here and let's pop into /GC. And when we're talking about this particular contract, the gold contract itself, the larger gold contract, this is for 100 ounces. This particular futures contract, this large contract, represents 100 troy ounces. And the 1 ounce gold futures contract represents 1 ounce. So that's where you kind of get that. There is also, though, for instance, if we think about it, so let's think about through the contract sizes. So this is 1,000. This is 100 troy ounces of gold represented by each contract. /MGC is 10 troy ounces. So this is a tenth. And then / whoops, let's do that. /1OZ is the 1 ounce contract. So yeah, it's representing in ounces, but it's the contract size that is represented in each case. So you can see the difference in terms of notional value. This is $4,000 in notional value /MGC, notional value 41,000 /GC is 413,000 in notional value. So choose your size according to the size of exposure that you want to have using that particular instrument. And not all sizes would be appropriate for all accounts in terms of notional value and in terms of initial and maintenance margin, because you see that the initial margin here, 22,000, the initial margin in /MGC, /MGC, that initial margin is, let's do the drop down here, is 2,200. And then that would mean that our initial margin here in the 1 ounce contract, 220. So again, the flexibility, and this is really, I think, a factor of representing. Let's pop over here, and I wanted to pop over to our futures landing page for just a second. If you want to kind of see a breakdown of the futures products that are available and the futures markets that are available, you can come here to schwab.com/futures and kind of get a little bit of a breakdown of that. You can see futures education. You can see futures commentary. You can see some content about introduction to futures, futures contracts, futures margin, questions about futures, futures markets as they are. So for instance, we'll pop in here to gold futures since we've been talking about this. So the fact that there are different size contracts is a function of demand, the demand for the product. And if there's demand for the product, then there's going to be a response by the exchanges that issue those products. And that can be, helpful in terms of different size accounts, different capital exposures, and paying attention to that. So there is a mini gold contract /Q0. And you can see the size here. So if you ever have a question about the size of those contracts or the way that those are broken down, micros, again, there's that 1/10. This is a fifth, the mini contract, the fifth, the size of the big contract, and a hundredth of the 1 ounce contract. You can see that information here at schwab.com/futures. The other thing you can do is if you are signed into schwab.com, you can come over here to the trade tab in schwab.com and you can go to futures and you can start to see a little bit of information about the futures market. So you can pop over here to a market overview for the futures market. You kind of get this. This comes from the CME. So this information is coming to us from the CME. So it is third-party information. This is not generated by Schwab. We subscribe to that feed from the Chicago Mercantile Exchange, or the CME, and we get that information. But it's a heat map, basically, of what's going on. And we've looked at this before in terms of this movement. There's no guarantee as to the accuracy of this content because it's coming from somebody else. But it can give us a sense of what's going on in the market. You can pop over here to charts and you can see some ongoing charts and contract specifications for those particular contracts. You can put in a symbol, so we could put in here or put in a comparison symbol / or what we could do in this case, GC, and we'd pick that gold futures contract and the most recent futures, the active contract. Click on accept, and then we'll go there. And then we've got a comparison chart that we can look at. So you can do some rudimentary charting here. So there's a fair amount of information that is available. You also get, again, market trading hours and those types of things here in this information. So I wanted to give you kind of that additional resource, if you will. And by the way, while we're here, pop over here to the Trader Talks webcast page, click on subscribe if you haven't already, and go ahead and click on the search button here and type in futures. And you're going to get a bunch of information about trading futures. There's Brent Morris talking about it. There's James Boyd. You're going to see Michael Fairborn talking about trading futures using pivot points. I know he talked about this a couple of weeks ago as well when he was covering this webcast for me as well. So I wanted to give you some of those additional resources before we get going here. All right. So this one actually happens to be, as we start to look at this, starting to make a little bit of a bounce move here. This is the 1 ounce gold futures contract, and it seems to be a little bit on the move here at this particular point. So what I'm going to do is I'm going to put together a trade, given the idea that maybe this is going to turn around and start to move back in that opposite direction. It's been pulling back. We pull back over here to this chart and we see, hey, both of these trend indicators, we talked a couple of weeks ago about the idea that we trade in the direction of the trend, right? From a directional bias perspective. We've got a strong CCI, so we've got some strong upward movement, even though we've got this little bit of a shooting star type of candle up here. We've got a 50-period simple or a 30-period simple moving average and a 10-period or 5-period simple moving average, both moving higher. And as we come back over here, looking for an opportunity perhaps to trigger an entry into what looks like a bounce. But I don't want to get caught in what might be another bear flag. If this has been coming down and kind of moving down, rallying up, moving down, rallying up, moving down, rallying up. I don't want to get caught on another bear flag. I want to get caught actually in a true reversal, maybe a triple bottom, inverted head and shoulders kind of thing. So I'm going to look for a break perhaps to the upside. Whoops. A break of a resistance level that had been a support level, looking for a bounce. So let me grab my magic marker here and we'll really kind of line this out. So down, up, down, and I'm looking for make it that kind of move back in the opposite direction, kind of this inverted head and shoulders or double bottom, triple bottom type of bounce pattern here. And if we can get that, then looking at trading in that bullish direction. The otherwise, if we take a bearish trade here, which you think is kind of the temptation at this point, to take a bearish trade and say, look, it's been going down. Momentum is on the negative side, but it's starting to gain. We get caught in that kind of downward perspective. We're trading against that shorter term trend. So I'm looking for, and this is one where we may potentially be willing to wait for this to move back in that bullish direction before getting into the trade. Now, we could do both. And we could create kind of that if this then that paradigm that says, fine, if it goes up, trade this in a bullish direction, or if it goes down, trade this in a bearish direction, and do two kind of branched OCO orders. But let's do this. I want to trade this in that trend direction, kind of staying consistent with that idea. So what I'm going to do is I'm going to look for perhaps that next area above. So I'm going to go back over here to this side. I'm going to say, where might be there the next level of resistance overhead if this really does kind of break out and start to move on a short-term basis? And so I'm going to zoom in a little more closely. I'm going to come over here and I'm going to say, look, there's probably a little bit of a resistance up here right around that 41.75. No guarantees of that. But once again, that would be an indication of where there has been perhaps a little bit of a resistance before. That's where those three candles kind of stopped here on that little bit of a bounce, couldn't break back up through, and then fell back down. So 41.75 is going to kind of be my overhead resistance. So I'm going to come back over here and I'm going to say, where is that 41.75? It's right up here. Where's going to be my exit out of this trade if it goes against me? So let's kind of label this once again. So if it goes down below this level, I'm going to get out 41.25. So let's label this with our stop, entry, and target labels. And we'll put this short-term trade together here really quickly as we look for this move to the upside. And remember, a big hurdle needs to be cleared here in order for this trade to get filled if we put this trade in here as a buy stop at 41.40. So I'm going to right click at 41.40. I'm going to create a buy custom with OCO bracket. And I'm going to say 41.40 is going to be my trigger. And I'm going to say, fine, buy stop at 41.40. So I'm going to change this from a limit order to a stop. It says stop, wait, don't do anything until price gets to 41.40 or higher. And I'm going to leave that on there for the day. If it doesn't do it today, then I'm going to come back and reevaluate the situation. But I'm going to leave it on there for a day. Now, if it goes up, I want to get out at 41. What did we say? 41.75. So I'm going to make my target, which is a sell limit, 41.75 or better. Sell at that price or better. And we're going to make that good till canceled. And then I'm going to say, fine. Or if it goes down, 41.25 on the downside, 41.25. And we're going to make that a stop, and we're going to make that stop good till canceled. Remember, that stop is going to create a market order. That market order is going to get worked by the exchange as a limit order. So there's a potential that even if I didn't enter this as a stop limit order, that could get gapped around and not fill. So you have to be aware of that risk that you could still be in this trade. So it might seem like belt and suspenders, but what we might also want to do is put an alert here, and we'll do that here in just a second. And not that an alert is a guarantee either, because an alert, I mean, I've had text messages that have not gone through, so sometimes that can happen with alerts as well. So this is how we're going to structure this particular trade, playing that bounce potentially to the upside or that breakthrough this short-term resistance level. We're going to put this order on. So I'm going to click on confirm and send, and I'm going to read through this, making sure that I've got the numbers correct so that we don't repeat the circumstances that we've had before. 41.40 is my buy stop to open. Stop, wait. Don't do anything until the price gets to 41.40, then enter the trade. And that's to open. And then a sell order if it goes up to 41.75 as a limit order. Because a limit order says or better. So sell it at 41.75 or better. And then a stop order says stop, wait, don't sell it until it gets to 41.25 or lower, then sell the contract. Making sure that we're aware of the transaction costs. We know what our initial margin is in this particular trade. And I'm going to put it here in our futures group, and we're going to go ahead and click on send. And that order is going to sit there and wait. Now, I know that seems fairly rudimentary, but it's, I think, and again, I'm going back to myself here, and I'm putting myself out there in terms of making sure that I am reading through and doing these orders, entering these orders in a methodical fashion, because in the last few weeks, I know that I have made some kind of rapid fire mistakes in trying to put trades on, in putting those trades on and not checking, not reading the order. So this is me using this opportunity to just say 100%. When you have a series of trades that maybe you've made errors on, take a step back, slow it down. Remember, we talked about the idea that slow is smooth and smooth is fast. But when you just rush through something and you have to redo it or it loses, then you lose the benefit of that, right? So we might be losing some of that momentum. I think you might be right, Thaya. We might be losing some of that little bit of momentum. And if that's the case, okay, we never got into the trade. So that's what I think might be potentially the benefit of orders that are structured around kind of a waiting condition. Because then if that condition isn't met, this is opposed to getting in on trying to get in on the absolute low that a lot of traders try to do, is getting in on an absolute low and saying, well, wait a second, why would I want to buy this that much higher? Well, it's because then at that point it's doing something that's telling me that it's going theoretically in the direction that I want it to go, and I'm not trying to bottom tick this. Yeah. And it does. You're absolutely right. You start to see a little bit of fade in momentum, but we could still see this bounce and turn back around. So in any case, we've got that order in place, and we'll see if that continues to move. On the shorter term chart, sitting on that support level, longer term chart on the 1-year daily chart, in this particular case, our moving averages are still moving in that particular direction. So once again, we could also turn this into a longer term trend trade. Let's come back over here and let's take a look at our monitor tab and see how that trade that we had on is going. So we have our /MNG. This is the one that we put on our natural gas trade, and it's going in our favor at this point. We still have this /MZC, our micro corn futures trade. Let's take a look at that one really quickly here. /MZC. This is our micro corn futures contract. And you can see how this trade has kind of progressed. We put this trade on back here. It moved in the direction we wanted it to go, got really close to triggering us out on our target, and it has now pulled back a little bit. It's just under our entry price, so it hasn't really lost us anything, but neither has it really made us anything at this point as it's been going on. So we've got to consider, do we want to keep this trade on, Or do we want to take this trade off and then look for another opportunity to get back into the trade? So what we're going to do is I'm going to come back over here to the monitor tab. It's lost us about $10. We're roughly at even, but we're getting down to the point where that contract is getting close to rolling to the next active contract. So what I'm going to do is I'm going to look at exiting this position, and then we will look at re-entering this position on another condition. So I'm going to go ahead and I'm going to sell this one because at the moment it's just not doing what I want it to do. So I want to click on confirm and send. Now, we don't have time decay in the futures contract necessarily, but you do have to, if the trade's not moving in your direction and it starts to move against you, there is that potential that you could continue to see losses mounting and mounting and mounting. Because remember, this could continue to go down. Even though we've got that stop, there's the potential that it can gap around that stop. So I'm just going to go ahead and I'm going to close this down because it's not doing what I want it to do in this particular case. I'm going to click on send, and we're going to fire that order off. And we'll see if we can get out of this order here. Let's see if we can close that down. And it closed, so we're out of that short-term trade. And we're going to look at potentially getting back into that trade if it moves back in the direction we want it to move. All right, so let's do this. I want to kind of finish up really quickly with this by coming back to this futures grid as we kind of roll into the cash market this morning, kind of get a sense of what's happening in the market around. So let's take a look at the S&P 500 E-mini futures. We talked a little bit about that. From a trend perspective, that trend is still intact, and we had a pretty good bounce off of that support level. But today, kind of backing off just a little bit, maybe running into that resistance. This is sometimes called either an advanced block or an advanced block or a deliberation candle. So maybe not really seeing, again, a lot of upward momentum. Yeah, Kelly, absolutely. Good point. If it's not doing what I want it to do, you know, oftentimes I think we tend to kind of babysit positions that are not doing what we want them to do, hoping that at some point that they will. But here on the ES, not breaking out yet, and momentum kind of falling off a little bit. The NASDAQ futures /NQ here doing the same thing, kind of that deliberation candle or advanced block type of candle. And I think this is maybe kind of a wait and see to see what's happening with political issues that are going on. Same thing with the small caps here, kind of coalescing down right on the moving average. In this case, right on that 50-period moving average, giving us a little bit of a spinning top. Spinning top yesterday, spinning top today. Not a lot of momentum in these particular contracts. One thing I'm going to look at really quickly, though, is /CL, and that is crude oil, because it has been on the move a little bit, maybe breaking out of this short-term downward channel, helping to define that short-term downward channel. So that's something that may see some upward lift here And my thought here is, if we look at /RB as well, that maybe there's a little bit more gasoline demand at the moment, because as we get ready in the next few weeks to go to grandma's house for Thanksgiving, more people perhaps are thinking about driving or have decided to drive regardless of whether or not the airlines are operating, simply because at this point, maybe it's easier. So some thoughts as we get into the end of this discussion. My thanks to Michael Fairborn for helping out today in this discussion. My thanks to our great reviewers and our great producers for helping out as well. And thanks to all of you. Remember to fill out that feedback survey. You can follow me on X at Ben Watson CS. Follow Mike on X at Mike Fairborn CS. And click on that subscribe button. Give us a like as well. We'll see you guys again next week, and have a great week. I will be back, I think, later tonight teaching after the close. So we will see you then. Take care, everybody. Bye-bye.